Hello and welcome back to this channel. Ultimate Intermediate Wyckoff Price Action Trading Course Lesson 7. This video will demonstrate how you can recognize the 4 Wyckoff price cycles. Market always changing from one cycle to another and never stay in one cycle forever. The 4 Wyckoff cycles are accumulation, markup, distribution, and finally markdown. This video will enhance intermediate and beginners trading knowledge to the next level. You will recognize the price reversal and when and how the price breakout and breakdown the accumulation or distribution cycles. This is an excellent opportunity to identify the high probability trading setup and make profit from the stock market. The 4 price cycles offered by Richard Wyckoff using volume spread analysis and different terminology. Before I continue, I want to ask all viewers, have you ever made money in some period and lose them all later? This is because the market always changing and in transition from one phase to another. It means if you are using a trend trading strategy, then you will lose money in range markets. If you are in range trading strategy, then you will lose money in trending market because each one has their own strategy to work with. The profitability of trading systems seems to move in cycles. There are times the stock is trending and moving strongly upward or strongly downward. This is the profitable cycle traders love to participate. There are also times the market shift to directionless price action and become unprofitable for inexperienced traders. These cycles could be accumulation, as Wyckoff suggests, which price drop down to a lowest level and it starts to attract the smart money which they want to buy the stock at the lowest price possible. It could also be a distribution cycle which we see a volume increase at the end of an uptrend. In this case, the trend undergo range and consolidation for months. So in general, we have 4 different cycles to introduce and discuss in this video, and they are as follow. The first one is accumulation cycle, and some professional they call it support. The second one is markup, as Wyckoff suggests, and some others they consider it as uptrend or advancing cycle. The third one is distribution or resistance, and finally the fourth one is markdown, as Richard Wyckoff suggests, or some other professionals they consider it as downtrend or declining cycle. Let's see graphically what are Wyckoff different price phases, and then I analyze them all through several practical examples. General representation of Wyckoff price cycle. There are times this stock is trending and moving strongly upward or strongly downward. This is the profitable cycle traders love to participate. Let's assume the price is moving strongly downward. As Wyckoff suggests, this is they call markdown or downtrend. Now, there are also times the market shift to directionless price action accumulation cycle, which price drop down to a lowest level and it start to attract the smart money. And they want to buy the stocks at the lowest possible price, and this is they call accumulation cycle. So the price moved down to the lowest level, and as Wyckoff suggests, this area it considered as oversold area, and this is they called resistant area. Now the price consolidate and range in this area for months. So here the smart money take advantage of this strong downtrend. The price come to the lowest possible level around here. So the smart money, they bought all the shares or lots of shares, and the bearish pressure become very weak and the bullish become very strong. So the demand become very strong and supply very weak. So what happened after months? The price will move up. So this is they called accumulation cycle. So after that, the price break the resistance and heading strongly upward. This is they called a strong uptrend or markup, as Wyckoff suggests. So the price moving upward, all the way upward, and look what happened. The smart money that they bought so many shares here at the lowest price, now the price move up all the way, and around this area the smart money wanted to sell their share to take their profit. So what happened? It make the uptrend, the strong uptrend, halted and forced the strong uptrend to distribution cycle. So at this point, the price shift into directionless distribution cycle, which we see a volume increase at the end of an uptrend. Why volume increase? The volume because of the bearish pressure. In this case, the trend undergo range and consolidation for months. Let's see what happened. So the trend continue going into range and consolidation. So the Wyckoff suggests this area as overbought area. This is support area, and that is the distribution cycle. So when the price range and consolidation in this zone for months, finally the bearish pressure become very strong, and what it does, it break down the support and heading strongly downward. So we are entering to the fourth cycle, which is called markdown, as Wyckoff suggests, or downtrend cycle. Now in our newest next slide, we are going to talk about these four cycles in details and show you how you enter the market, how to exit the market, and you put your stop loss. So this is a very important four cycles, Wyckoff four cycles, that you have to remember. Accumulation phase or accumulation cycle. This is the price trend Coca-Cola stock T1 time frame, and this is the resistance level, and that is the support level. Now when the price is falling for a couple of months and reach near the bottom, that is the bottom, these are bottom, the price dropped down to its lowest level, to its lowest possible level. The volume tends to increase due to bullish pressure or a strong increase in demand. Absorb the supply, or in other words, smart money start buying low and sell high in future. So when the price coming down to this level, so the price drops so much, and the smart money, the institutions, people have lots of money, they buy their shares around these areas. Around this area they buy the shares. In this situation, we can witness a slow transition from downtrend into directionless, unprofitable accumulation phase, which you see that the price is ranging and consolidating within these two levels, support and resistance level. The price advancement becomes smaller and smaller until it becomes flat, sideways. The bearish pressure or the supply dies out and little demand needed to catch up with the supply. This cycle may last anywhere from months to even years. In this cycle, bulls and bears are in equilibrium, within the range, within support and resistance. Resistance and support. And the bull and bear have almost the same up days and down days. Up days and down days. So basically they are basically in equilibrium. The accumulation cycle are also referred to as oversold area, as you have seen it in Wyckoff price cycle. When we also see the volatility sideways swing, price retest its low here around this area, retest its low. And we may also see patterns and formations like double bottom, reverse head and shoulders, hammer, morning star, which all of them are the sign of an uptrend price reversal, which in turn it's a sign of shortage in supply and increase in demand lead to an uptrend reversal eventually. You see that the price is going to break the resistance and go heading upward. At the end of prolonged range sideways trading in accumulation cycle in time, the bearish power become weak. All the bearish power become weak, and the bullish won the battle, since there was not a lot of demand needed to deal with weak supply, bearish, and therefore the breakout, the price from this range was inevitable. Accumulation cycle can also occur during an uptrend. You see, this accumulation cycle can occur in an uptrend and has the same characteristics and should not confuse with distribution cycle. Accumulation cycle in uptrend takes longer time compared to accumulation after the downtrend. Multiple accumulation cycle in uptrend. This is the price trend, Apple stock D1 time frame. These are the resistance areas, and these are the support area. The price originally coming strongly downward till it reached the bottom of a downtrend, then enter this accumulation cycle. We see small transition from downtrend into directionless, unprofitable price action. The advancement become smaller and smaller till the trend become flat and going sideways, the low fluctuations and low volatility. Here, the smart money, the big institutions, banks, or people with lots of money, they take advantage of this low price and they buy lots of shares around the support. And therefore control the market. The bullish pressure finally, after months the price being in accumulation, it break out the resistance and heading upward. Accumulation cycle does not necessarily has to occur after a strong downtrend. In many cases, we see accumulation cycle between an uptrend. In this case, the price break out the first accumulation cycle, like here, and move upward and then enter the second accumulation cycle. Enter the second accumulation cycle, and finally it break out the resistance and going strongly upward. It again enter the third accumulation, and after months that is fluctuating between this support and resistance, it finally break the resistance and going upward. Here it is important that you do not confuse this with distribution cycle. In accumulation cycle, we see higher volume bars on positive price bars and lower volume bars on negative price bars. It means bullish control the market and bearish lose the battle. Whereas in distribution cycle, we see low volume and low volatility caused by hesitation among investors. As a result, price break the support and heading strongly downward. For example, if this is the distribution cycle, instead of the price break out the resistance, it break down the support and the price heading downward. Like for example, if this be distribution cycle, the price should go downward. So the smart money or the smart investors are buying stocks in accumulation cycle around support and sell them in distribution cycle, which I'm going to talk about it later. I recommend you strongly that you do the same thing. Always buy in accumulation cycle near the support. You see around this area where you see price rejection, that I'll talk about later, and sell it in distribution cycle. Markup or uptrend cycle. This is the price trend Lowe's Corporation D1 time frame. Uptrend is usually occur after the price break out the accumulation cycle, which is around here, and heading upward with low volume since there is not considerable supply or bearish pressure to deal with. As it continues going upward, we see a series of higher high and higher lows, higher high and higher lows. This behavior of the trend continue until the trend reaches to the top of an uptrend. Now, higher high because the short-term traders and also frequently by long-term traders collect their profit and they go short. And we also see lots of traders, they enter the market where it marks higher low. This cause an increase in demand or bullish power, and the trend is going up strongly. So that is, you see, that's a strong uptrend. Uptrend can last anywhere from months or even years. They have more up days than down days. The up days is more than down days. The up days they called the long leg of the trend, and down days they called the short leg of the trend. So all the time the long leg is bigger than the short leg of the trend. And another things that another characteristics of a strong uptrend, you see the long leg, you see there are more bullish candle than bearish. You see here, basically there is not at all bearish candle. Here the same thing, here the same thing. So that shows a strong uptrend. And here the same thing. And then the short leg of the trend, you see more bearish candle. You see, more bearish candle. That is the characteristics of a strong uptrend. Now, as the trend go up, at the end of an uptrend, which is here, we see a strong increase in volume. Why? Suggesting the smart money start to take profit. Who is the smart money? Institutions, banks, millionaires, people with lots of money that they have so many shares. They sell their shares in order to collect their profit. So what happened after? This uptrend become halted, and the bullish power becomes so weak, and the bearish force the trend into distribution cycle. So the price and distribution cycle between support and resistance, they consolidate, range, and also sideways market. And you see there is the volatility become very low, and also the trend has little fluctuation, and finally it forces the trend to break the support and going downward. Now in the next slide we are going to talk about the distribution cycle. The third cycle is distribution cycle. This is the price trend, the GGB stock T1 time frame. This is the resistance area, and this is the support area. When the price reached near the top, going upward and reached near the top, the volume tends to increase due to bearish pressure, or a strong increase in supply absorb the demand, or in other words, the smart money starts selling or taking profit, as we explained in previous slide. In this situation, we can witness a slow transition from uptrend into directionless, unprofitable distribution cycle or distribution phase. The price advancement becomes smaller and smaller and smaller till it becomes flat, going sideways. The bullish pressure or the demand dies out, and the buyer do not willing to pay higher price in distribution cycle. The cycle may last anywhere from months to even years. In this cycle, bulls and bears are in equilibrium within the range, resistance and support level. And bulls and bears have almost the same ratio of up days and down days. Up days and down days, the bulls and bears. The distribution cycle are also referred to as an overbought area, as you have seen in Wyckoff price cycle. We also see volatile sideways swing and price retest its high, and we may also see patterns and formations like double top, head and shoulders, shoulder pattern, shooting star, evening star, which all of them are the sign of downtrend price reversal, which in turn is the sign of shortage in demand and increase in supply. At the end of a prolonged narrow sideways range trading distribution cycle in time, the bullish power become weak and the bearish won the battle, and therefore break down the support and going downward. So this is the characteristics of distribution cycle. The price going up into the distribution cycle and then break down the support and going downward. Finally, the last cycle is markdown or downtrend cycle. This is the price trend crude oil stock D1 time frame. At the end of a distribution cycle, as we saw in previous slide, the demand or bullish pressure is strongly weakened and near end, and we see a strong increase in supply or bearish pressure, and the trend dive into downtrend. Here we see higher volatility, higher volume in bearish side. The selling pressure is stronger. The selling pressure is stronger than buying pressure. Selling pressure, buying pressure. So the selling pressure is stronger than buying pressure. Downtrend is usually occur after the price breakdown, the distribution cycle, and heading downward with low volume at the beginning, since there is not considerable demand or bullish pressure to deal with. Downtrend can last anywhere from months to even years. There are more down days than up days. Down days than up days. As the trend continue going downward, we see a series of lower swing low and lower swing high. Lower swing low and lower swing high. And this continue all the way to the bottom of a downtrend. And this is the characteristics of a strong downtrend. Lower swing low, lower swing high, because the short-term traders, they go short, and therefore we see an increase in supply or bearish power, and the trend is going strongly downward. Some traders, they go long, where it marks lower swing low. They go long and they take advantage of a small uptrend, and you see that it's all bullish candles. I do not recommend, because they are going against the trend. The trend direction is downtrend, where they enter the market upward. At the end of the downtrend, we see a strong increase in volume, suggesting the smart money, the institution, people have lots of money, buying stop at its lowest value, causing the downtrend collapse and halted, and the price eventually entered the accumulation cycle again, where we start at the beginning of this video. So these were the 4 Wyckoff cycles that I explained clearly. And the next slides, I'm going to talk about how you enter the trade in these 4 cycles. Best trading strategy for accumulation cycle. This is the price trend Walmart stock D1 time frame. This is the resistance area, and this is the support area. Now, the price originally it's coming strongly downward into this range or accumulation cycle. My first choice to trade this cycle is I prefer to go short, because it's very hard to recognize the accumulation cycle before it finishes. Well, I don't know whether this is going to go upward because it didn't finish, or before it's over. The trend originally going downward, so there is a big possibility or probability that the trend continue going downward after this again. So that is the reason I prefer to go short. The price may go in accumulation cycle, but after a couple of months you see again the price declining. So we conclude that it was not accumulation cycle at the first place. The second choice is you consider this accumulation cycle as a range bond. Now, first look for price rejection at the support level around here, and find patterns that show you the price reversal like a hammer, and you can enter the market here and you put a stop loss 1 or 2 ATR below the support. Or you look for price rejection near resistance area, and you can go short and put your stop loss 1 or 2 ATR above the resistance. This is how I would do it. Best trading strategy for distribution cycle. This is the price trend Walmart stock D1 time frame. This is the resistance area, and this is the support area. Distribution cycle usually occur after the rise in price and look like a consolidation period. The price contained within the range, which is support and resistance. That's the resistance and that's support. So this consolidate within the range, where within the range the supply and demand basically they are in equilibrium, or bulls and bears are in equilibrium. In distribution and accumulation, the up days and down days ratio basically they are the same. The volatility in distribution range is high. The best trading strategy that we can adopt here is considered distribution cycle as a range bond. So we can enter the market around the support area and exit the market around the resistance area, which are upper and lower band. Now, let's say if you want to enter the market in support area, what you can use price rejection, candlestick pattern, and formations like hammer, engulfing, and morning star in order to enter the market here around support area. And when you enter the market, then you put your stop loss 1 or 2 ATR below the support area. And also, when you want to exit the market, you exit the market around the resistance area, use again price rejection like shooting star, bearish engulfing, evening star, and so on, in order to exit the market. And when you exit, you put your stop loss maybe 1 or 2 ATR above resistance. 1 or 2 ATR above resistance. That's how you can trade distribution cycle. And my opinion is, since the trend is going upward and you do not know where this distribution cycle ends, then you can consider this an upward, and you only enter the market. So you go with the trend. The trend is upward, although it goes into consolidation, but you still can enter the market, not exit the market. But I'm not saying that it's wrong if you exit the market. But since the original trend is upward and you do not know whether this is really a distribution until it finished, so the best choice is to enter the market. So this is the way you trade a distribution cycle. Base trading strategy for uptrend cycle. This is the price trend, ERF stock D1 time frame, and also I installed SMA 100 as a market structure. Now the trend is making higher high and higher low. As we explained before, this is the characteristics of a strong uptrend, which is trending and going strongly upward all the way to the top. Now, when it reached to almost to the top, here you see the market doesn't make higher high anymore, and instead of that, it makes lower high, and then after it makes lower low. So this is where the price broke the structure, and you see here we have to exit the trend. All these trend is upward, and from here the trend is going downward from here. So this is where you exit the trade. The trade. Now these are the area that is close to the market structure. That is where you enter the market, and these are areas that the short traders, they usually exit the market, the higher high. So now I'm going to show you exactly what is the procedure in order to enter this trend. The trend trading is the best trading strategy to capture the trend. The first requirement is to draw your market structure like SMA 100. that I draw a simple moving average with 100 days period, you can use SMA 200, you can use SMA 50, or the other market structure is trend line and Fibonacci levels, and there are so many more, but this is up to traders to decide which market structure they use. Now I draw here simple moving average with 100 days period in order to identify the market structure. Now the second thing you need to know is wait for the price that come to the market structure. The price has to come close to market structure in order to that you be able to enter the market. For example, this is an ideal situation. This is an ideal situation. This is also ideal situation, but these are not an ideal situation because the distance between higher low and the market structure is too high, and if you enter the market here, you are going to have a wide stop loss and you are going to have a poor risk to reward ratio. So wait for the price to come to market structure, and the next thing you have to do is use price rejection, price reversal, and formation to enter the trade. Here there are some formations like, for example, hammer engulfing or morning star, that it show you that the price is going to reverse, so you enter the market. And then after that, what you have to do is you put your stop loss. You put your stop loss as soon as the next candle open above the swing low, higher swing low, then you can enter the market and you put your stop loss below higher swing low, or below to market structure, maybe 1 or 2 ATR below the market structure. This is how you trade the uptrend cycle. Base trading strategy for downtrend cycle. This is the price trend K stock D1 time frame, and also this is SMA 100. They here act as dynamic resistant. The price originally going downward and making lower swing low and lower swing high, lower swing low and lower swing high. Now, as I explained before, this is the characteristics of strong downtrend, and this continue all the way to the bottom of a downtrend. And trend trading is the best trading strategy to capture the trend. So there are some students, they ask me, what is pullback? I can show you now what is exactly pullback. Here the trend is going downward and then make a pullback toward resistance, and downward pullback, downward and pullback. So these are the shorter leg of the trend. In downtrend is a pullback. So these are the shorter leg of the trend, and this is the long leg of the trend, and that is downtrend. Now, there are many people, they ask me where the pullback ends. The pullback basically ends in, if you are in uptrend, it ends in support area, and if it be downtrend like this, it ends in resistance like this one. That's the resistance, that's the dynamic resistance. SMA 100 act as dynamic resistance. Here the pullback ends in dynamic resistance. Same thing here, same thing here. So this is the first one. The second one, the pullback ends in moving average, and also the third one, the pullback ends in trend line. If you, let's say, draw a trend line, that is acting as a dynamic resistant. Now, another question is, how you trade, how you trade this pullback, how you can make money. That's very important. So the first thing that you can use is candlestick pattern, price rejection and formation, candlestick math blending, you can use that. And so let's say if you have, let's say, a hammer here, that's a sign of price reversal. Or even at resistance level, if you use a shooting star, if you see shooting star, that is a sign of a price reversal. So you can exit the market here, and if you have a hammer here, you can enter the market here. And this is the first thing. The second thing is you can use trend line. Trend line is another one that you can use in order to exit the market or enter the market. Let's say if you draw trend line here and this pattern break the trend line, so you can use that as a sign of enter or exit the market. And the last one is break off the structure. Here, look at the structure is, it makes lower swing low, lower swing high, lower swing low, lower swing high. So that is the structure. That's how the structure it look like. And if this structure come here all the way to the downtrend, and suddenly instead of going up and making lower swing high, it makes higher swing high, and then the next one is higher swing low. That is the characteristics of an uptrend. You see, that is make higher swing high, higher swing low, higher swing high, higher swing low, higher swing high. That's the characteristics of an uptrend. So the minute that you see it break the structure, that is the sign that you can enter the market. So that is again another way to enter the market. Now, where you're going to put your stop loss. For example, if you are here and you enter the market to take advantage of this short leg of the trend, then you can put your stop loss below the lower swing low, maybe 1 or 2 ATR below. And if you exit the market, let's say here on the resistance level, you can put your stop loss above the dynamic resistance, maybe 1 or 2 ATR above dynamic resistance. So this is how you can put your stop loss. It's very easy, and you only need practice. And here in dynamic resistance that I draw SMA 100, you can put SMA 50, you can put SMA 200, you can put SMA 20. So you have to practice in order to see how many points this SMA is going to catch. So the more, the better. So that's how you can trade pullback in downtrend cycle. That's all, folks. If you like this video, thumbs up and subscribe. Thanks for watching. Take care and see you next time.